Welcome to Share Views with the very florid Stefania Barbaglio from Berkeley Services and with our guest, Charlie Long from Beaufort Securities. You're a resources analyst there, aren't you, Charlie?
Indeed. Good afternoon.
Good afternoon to you. Good time for resources, or is it a little bit off the boil now?
Well, it looks a little bit off the boil if you look at the market, if you look at the share prices in recent weeks. I was one of those analysts that was a bit cautious on China last year, and I'm still cautious on China. China being obviously the biggest importer and consumer of pretty much everything on the commodity front. So still cautious on the miners and the commodities.
I mean, the Trumpflation trade was partly on the mining side. Is that dead in the water now, from your perspective?
I don't think it was ever real, in the sense that certainly for infrastructure development it takes a long time to get anything permitted and through from an idea, planning through to construction. So any of those infrastructure projects that he's planning are going to be 3 or 4 years out, and lots can happen between now and then.
Right. And the other issue, I think, with China, which we're going to touch upon, is that of the fossil fuels in that area, and whether that's China's going to drive, let's say, the uranium use or nuclear power over the next few years. How realistic is that?
I think it's very realistic in the sense it's happening. Just look at the numbers of reactors that they're building now. And look at, say, the US. I think a lot of people don't realise how big the US is in nuclear, and China's just trying to catch up. And of course, it's 5 times as big as the US.
And also Japan as well is starting.
Japan is starting again, but I think really the Chinese and various other countries are sort of replacing that Japanese demand that was lost for uranium. I don't think the Japanese are going to go back to 48 reactors that they used to have. They're I think they're on number 6. They've turned on 6 after Fukushima. So it's, time will tell if that goes to 10, 15, 20, but that's a slow process. Chinese, they're building 26, I think it is at the moment, reactors under construction.
One here,
even the US are building 4. Well, we'll see what happens. But the US has got 100 reactors. Versus the Chinese, I think they've got 30 with 25, let's say, under construction. So the Chinese have got a long way to go, and as that demand continues to grow, the demand for uranium will grow.
That's it, but that's a $64,000 question. Why is uranium price still so weak from resources?
Because after the crisis in Japan, the Japanese, which had 50, I think they had 50 reactors, 48 were power generators, that went to 0, and all the utilities out there, I think KEPCO is the main one, they had long-term contracts, so they continued to buy uranium because they were obliged to. So they've got big stockpiles of uranium, but they weren't using any of it. So since then, stockpiles of uranium have been building and leaking out into the market.
Right, just to prove to people that the Chinese may need to replace some of their fossil fuels with other more clean fuels, we do have a little video to show the general public, I believe.
Nice, very nice. Not ideal.
Well, that's pretty scary.
It's not very nice. It was like that in London, was it not?
Well,
not that long ago.
yes,
it's not that long.
Well, no, I think
50, 60 years ago, or 70
yes,
years
exactly,
ago.
yes.
But some I think also European Union, they are quite sensitive to the clean energy environment, and particularly supporting companies.
Yeah.
They are in this space, and on this point, I would like to bring up Berkeley Energia, which is basically, I would say, the one of the only company listed on the London market that is actually operating in the uranium space.
Yeah.
So do you know the company? Are you following them?
Yeah, Berkeley Energia is, as you say, it's the only way really of getting exposure to a good quality, relatively large company on the UK stock exchange. It's got decent volumes as well. I think the market cap at the moment is about $160 million. Something like that, so it's a pretty well followed and traded stock. It's got a deposit, Salamanca project, which is in Spain, so it's in a sound jurisdiction. and obviously a lot of uranium comes out of Canada, the Athabasca Basin, but also out of Africa. And I'm not having a go at Africa, but if you had a choice of buying, if you're a utility company and you have a choice of buying your uranium from Spain, let's say you're a French Areva, do I buy it from Spain or do I buy it from somewhere else, perhaps in Africa? You probably go for Spain. So it's got a little bit of an advantage there. It's got decent grade. It's very, very shallow, so very low stripping costs, and overall their cost of production, they're expecting it to be around $15 per pound, which I think is that's over the life of the mine. I think 20 is probably a realistic near-term number, what they'll be producing at the beginning, and that's very competitive for the for the global uranium space. So it's a good project, good grade, sort of, except for say the Athabasca Basin in Canada, which is very high grade but deep underground, expensive to develop, relatively low capex to develop, and in a nice place. So the only thing they need is the uranium price to go up, or a contract, an offtake contract.
Yeah, I mean, Paul, I spoke with the managing director, Paul Attlee. He was in China recently, so I'm sure that the company, is looking after their plans on how they are going to possibly bring in a strategic partner, that can help with the project. But not to forget, they have full support from the European Union, so that's quite important.
Yeah. I mean, they've got $30 million thereabouts.
Yeah, 29 million.
So they're not strapped for cash. They started to develop slowly the mine, started construction, started ordering, the basic groundwork, started ordering equipment. But yeah, if they can get, and they do have a sort of small offtake with a trader.
Yeah, with a company from, is a sister of Glencore.
I think the price, the sort of long-term price for that contract is about 44. So although the uranium price is low and now it's around the 20s, if you're a utility company, the cost of uranium is almost irrelevant for the overall economics of your business. And if you want stable long-term supply, you'll pay more. You'll typically get a long-term contract, and obviously Berkeley have signed this $44 a pound long-term contract, albeit quite a small one. What they really need is a utility or some other sort of uranium partner to come in, pay 40 for all their production or the balance of their production, and then all of a sudden it unlocks the whole thing. The price of uranium becomes less of an issue, no issue, and then it's just about constructing the mine and going into production.
But given the energy demand, the steepness of that curve over the next few years, and how many reactors are being built and going to be built, isn't it surprising that somebody hasn't bitten off Berkeley's hand, or both hands, already? I mean, as soon as the site was identified.
Well, I think the natural player in that space would be Areva. Obviously, it's the French company, partly state-owned. And I'm sure that would have happened, as sure I can be, had it not been for some of the other less good M&A sort of transactions that Areva were involved in, such as Uranium, where they wrote off billions of dollars because of, I think it was about $2 billion in the end, because of a terrible investment in Trikopi in Namibia. So had they had a strong balance sheet, and they hadn't done deals like that, then I think Areva would have probably been in there before Berkeley Energia. But this is a long-term game, and Berkeley have got this fantastic asset in a good jurisdiction, low-cost mine. It's just a matter of time before the value really comes out.
Inevitable process, it appears
sort of, but I don't think necessarily Areva will buy it in a couple of years' time, because I'm not sure they have the appetite anymore for that sort of M&A, but certainly the value of the project will become much higher once the uranium price starts to pick up.
And also next year, has been identified as the tipping point for the uranium price to turn. I mean,
possibly. I don't know. There's different.
I mean, it's trading at $21, $22 per pound. So we need to go back to 60 in order to see a significant. That should be done by 2020. That's what they
but I think if Berkeley can sign a long-term offtake agreement at say 40. then to some extent that doesn't really matter. And then in 5 years, say it's a 5-year contract, in 5 years' time, they're making some nice money, the term contract comes to an end, and at that point, I would imagine the uranium price is much higher than.
Let's just go from
60, 70 by then.
Starting to run out of time, but let's go from uranium to gold, which
Yes, to gold.
is already started to go higher, and either on Trump worries or other things.
This is actually just a daily. That's today.
Yeah.
Although it says May the 17th, but this is it's around 1260 at the moment. The price, it's had a little uptick, and I want to talk about Hummingbird because if you look at the AIM market, it's one of the only, if not is the only company in that construction phase going into production.
They are going by the end of the year, isn't it?
I think their first gold pour they're aiming for December, but their sort of profitable production will be in 2018, sort of Q1, and they're going to be a significant size producer. They're aiming for 130,000 ounces in, I think, their sort of first full year of production. And their cash cost, their all-in cost, they're hoping is going to be around 700. Now, if you assume, say, just 100,000 ounces and an 800 cost of production, they're going to be making $40 million of EBITDA versus debt of about 60. If they make 130,000 ounces and at $800 an ounce cost, they'd be making $75 million of EBITDA. So they'd be able to pay off their debt in less than a year. And massively geared to the gold price. And if you're making 100,000, every $100 on the gold price, you make another $10 million.
It's quite interesting to see, to look at the chart because it kind of looks like the share price being bouncing around the same level. So we haven't got any particular drop. But they did a placing around 22, 20, and now it kept trading kind of like the same range.
But they're double what they were at the beginning of last year. So
and I think people are waiting now for that ramp up phase and going into production. And some people will buy just before that starts happening. Some people might sell as it starts to happen to take away that risk. But it's all about execution.
So where are you seeing the share price to go?
Well, I think it will probably stay within a range over the next few months. But as they get close to commissioning the mine and ramping up into commercial production, then I would expect the share price to tick up. And especially if the gold price does well. If the gold price does well and they execute, they don't need any more money, then this could be very good in, say, Q4 of this year and the first half of next year. It all depends on execution.
Well, we shall see how that goes. Charlie Long, resources analyst at Beaufort Securities, thank you for joining us here on Share Views today.